I've never paid a down payment for any piece of real estate that I've acquired. I've satisfied down payments, but never tying up any of my own money. And so in this educational episode, I'm going to talk about how to safely leverage with full liquidity to make infinite rates of return like banks do. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping people optimize assets and minimize taxes. And I've been helping thousands of people learn how money works. I've been very blessed in my career to have authored 12 best-selling books thus far in my career. In all of my books, and in fact, ever since the mid-1970s when I started in 1974, I've been personally using the banking concept with my own money, and I've been teaching it to my clients. And when I started to write books and release them at the turn of the century, I have talked about this banking concept in all of the books. Now, I'm not trying to take credit for being the original thinker on this. In fact, the banking concept has been around for centuries. I teach on this very channel that the parable of the talents in the New Testament in Matthew chapter 25 and in Luke 19, the parable of the pounds is really a take on the banking concept, how money works. And so I understand there are many financial advisors that have picked up on this banking concept and they label it with their own twist. And I'm not trying to take away from any of theirs. Nelson Nash, who I have met, he called it infinite banking. And after my third New York Times best-selling book came out in 2007, of which the concept was taught in that book, my third book, Chapter 7 was actually titled Learn to Become Your Own Banker. And so in 2008, a year later, he came out with a book called Becoming Your Own Banker. Pamela Yellen has a book called Bank on Yourself, is what she calls it. And I think that was published in 2009. Now, Pamela has asked me to make it absolutely clear that we are not affiliated with Bank on Yourself. We are not sponsored by them. In fact, I don't even endorse Bank on Yourself. Is their concept legitimate? Yeah. That's not how I apply the concepts, but I call mine the laser bank concept or the family bank. However you talk about it, it is simply how money works. So in this episode, I want to address how you can apply these concepts, become your own banker, set up your own family bank or your own laser bank. And you're going to understand why I prefer to use indexed universal life, because I think this is the banking concept on steroids, okay? And so let's make sure you understand where I'm coming from, because I've learned some of these lessons years ago the hard way. So many times when I would speak to audiences, I would act like, okay, what if I took a $100 bill and I buried it in a tin can in your backyard, okay? And I ask, is that $100 bill buried in a tin can in your backyard liquid? And most people would say, well, yeah, I can, as long as I remember where I buried it, okay? Is it safe? And some people would say, well, yeah, as long as my spouse doesn't find out where I buried it. And then I would ask, is it earning a rate of return? And without question, people would go, no. In fact, it's probably doing what? It's losing value because of inflation. So it's very easy to understand that a $100 bill buried in a tin can in your backyard is not earning a rate of return. And then I ask, so what's the difference between a $100 bill buried in a tin can in your backyard and the hundreds and thousands of dollars that we tie up in the bricks, mortar, wood foundation of our homes? I would submit that this $100 bill in the tin can is more liquid and safe than the money we tie up in equity in our homes, okay? And I learned that lesson the hard way. When you need money out of your real estate, and you really need it. The worst is the hardest to get because you're probably unemployed, you're probably disabled, and you try to borrow it back when you don't have the ability to repay. And so a lot of times people don't realize that money inside of that real estate is not liquid when you really need it, because lending institutions are only going to loan you money based on your ability to repay. They don't care how much equity you have. It's not safe. We've seen real estate values drop 10, 20, 30%. You will lose money if you have all of your money tied up in the property. I guarantee you. If you have it separated, you will not lose. And many times when my house has gone down in value through the years, I never lost a dime because my money was not trapped in the house. It was over in a portfolio of universal life insurance contracts. And even in 2008, when my house dropped in value from $1.5 million down to $1.1 million, I had critics go, "Oh, neener, Mr. Andrew, you're underwater. You owe more than your house is worth." Did I care? No, I had $1.5 million separated from my property, compounding tax-free. When it dropped down $400,000, if I would have left that in the property, I would have lost $400,000 for several years before the house came back up to $1.5 million. But I was earning on that $400,000 that was no longer in the house. I was earning twice as much as I was paying in interest. I was making 100% rates of return. And so I was in control, not the mortgage company. I could peel off half of what I was earning and make my mortgage payments. The mortgage company was happy with me. I was making twice as much as the mortgage cost. I was making money hand over fist by keeping my equity separated, because the house with equity in it, does not earn a rate of return. And so often I have illustrated this by using a working metaphor. And many times I will take a pitcher and I'll take a goblet and I will have water in the pitcher, which is equivalent to how much the goblet holds. And I say, let's say that this goblet represents your house and you've not put your first dollar of cash into it. And this pitcher represents your cash in a bank or better yet, in an insurance contract where it's liquid and safe. So I pour the money out of the pitcher into the goblet. But before doing so, I ask the audience. So I have a house, let's say it's worth $100,000, and I have $100,000 of cash. These are both classified as assets, right? Yeah, I have a $100,000 house and I have $100,000 of cash. I have $200,000 of assets. Now, I may have $200,000 of assets minus a $100,000 mortgage liability for a net worth of $100,000 day one. But day two forward, it's much greater if you keep them separated, because what happens if I pour all of my cash into the property? I pay cash for it. I pay a down payment. I pay it off. What did I just do to my assets? I just took one $100,000 asset, the property, and another $100,000 asset, my cash, and I just cut them in half. I just combined them into one $100,000 asset. I just cut them in half. So what happens if I keep them separated, or I separate this, and I put it back over here into the picture? Now, what did I just do to my assets? I just doubled them. So that's why I keep my real estate equity separated, because I have twice the assets. And this money here is compounding tax-free in my portfolio of laser funds, earning an average return of 9%. And the cost of the mortgage to separate it is 4.5% tax-deductible interest, which is a net cost of 3%. I'm making, on every $1 million that I've separated, I'm making $90,000 in interest the first year, and it only cost me $30,000. I'm making 3 times as much as it cost me. So pretty soon this pitcher compounds and is overflowing with money. And people say, well, how does that work in real life? Well, let me show you, but before doing so, let me just ask you a question if you're not quite connecting the dots. Many times I would ask my audiences, I have an investment for your consideration. You ready? How much would you invest in this investment? You determine the amount and length of time for your monthly contributions to continue into this investment. Is that okay? Most people go, Yeah, that's okay. You can pay more than the minimum monthly contribution, but you can't pay less. Ooh, really? No, you're committed. You can't pay less. In fact, if you attempt to pay less, the financial institution keeps all of your previous contributions. What? What kind of an investment is this? Oh, I'm not through yet. The money deposited in this account is not safe from loss of principal. You can lose the original amount you put in there. Oh, I don't know if I like this. Do you know that each contribution made to this account results in less safety? The more you put into it, the less safe it becomes. What is this? Well, the money in the account is not liquid. If you really need it in a pinch, you can't get it. The money in the account actually earns a 0% rate of return. Whoa, who would ever put money in this? Your income tax liability increases. Every time you make a contribution, you're killing your tax benefits. And when the plan is fully funded, there's no income paid out to you. How much would you invest in that? And people go, what is that? Now, some get it. I go, what is that investment? And they go, blood drains out of their face. It's a house. It's your house. Yeah. How much would, and that's what you're doing. So that's why I tell people, you know what? I've always kept my money separated. I don't pay a down payment. I keep it separated. I satisfy down payments, but I do it with OPM, other people's money. Every 100,000 of equity I keep separated. If I'm borrowing at 9% interest, and if that money is only earning 7.5% interest, people go, wow, you're going backwards. You're not getting ahead. Oh, really? Whoa, wait a minute here. If 9% interest that I'm paying is tax deductible in a 33% bracket, it's a net cost of 6. I'm paying 6 and I'm earning 7.5. You'll do all that for just 1.5%? Well, yeah, the first year I'm only making $1,500 on 100,000 of equity that I kept separated. But pretty soon you're earning, 7.5 compound interest on a bigger and bigger balance than you're paying simple interest on. Over a 30-year period, you'll come out ahead $750,000. Borrowing at 9 and only earning 7.5. And people go, I would have never dreamed. Well, what if you separated 150,000 or you kept separated 150,000 that you would have been tempted to pay against your mortgage or paying a down payment? And you borrow at 7.5 and you only earn 6. Well, over a 30-year period, that's 761,000, another $750,000. Hello? Well, what if you borrowed at 6.5 and earned 8.5? And people go, you'll do all that for 2%? Absolutely, especially if 6.5% is tax deductible. On 100,000, at the end of 30 years, that's $1,055,000. $1 million. Yeah, I'll do all that for 2%. That's what banks do. They borrow your money at 3%, and sometimes they only earn 5%. They'll do all that for 2%, and they make millions. You can make $1 million. That's on 100,000. Well, what if you did that with 500,000? It's 5 million. What if you did that with $1 million? That's 10 million extra dollars with a 2-point spread. Okay? But it's only a 2-point spread on the surface. It's greater than that if this interest is tax deductible and this interest is compounding tax free. Are you getting it? So the second example is 175,000 of equity separated at 7. What if you only earned 8? Here we go. You can stack up $1.5 million. What's the third example? What if you separated or kept separated 260,000 at 7.5 and you only earned 7.5? Most people would go, you're not getting anywhere. You're borrowing at 7.5, you're only earning 7.5. If you're borrowing at 7.5 tax deductible interest and a 33% bracket, it's only 5. If you're earning 7.5, that's a 2.5-point spread and it's compounding tax free. Guess what? $2 million. You'll make $2 million on just 260,000 over a 30-year period. Are you understanding this concept? Math doesn't lie. So this is the concept that I've been using for 50 years. I've been teaching it. It's not new. I'm not the originator. And if anybody claims to be the originator of the banking concept, just snicker at them, because this is as old as the Bible, okay? If you want to learn more about where I keep my real estate equity separated right off the bat, it's in a maximum funded indexed universal life insurance contract, but it has to be structured correctly and funded properly. Then it qualifies to be deemed a laser fund. That's why I call it the laser bank concept, okay? Not only that, but when you have money in your IUL policy, you borrow money out of your IUL policy. You could withdraw it, but it's the same concept. I borrow money. I can borrow at 2% and they'll credit me 2% because it's tax-free if I do it that way. But I can borrow $1 million out of my IUL policy, like many clients do, and they'll charge you 5% and they'll keep crediting you 10, 15, 25% or more. You can learn how to become your own banker by using your IUL policy with the same concept that I've been talking about. So if you want to claim your free copy of this book, simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you, priority mail. Also, there's options there to listen and learn, watch and learn. There's 200 pages of charts and graphs if you're a left brain learner, but there's also 100 pages of 62 actual client stories that teach you how it works through actual stories of how real people have applied these concepts using max-funded indexed universal life. This is about you and your brighter future. When you're in there claiming your free copy, if you would rather listen and learn or watch and learn, there's options there for those. Check out some of our educational webinars that we teach on a regular basis. They are free, and you can even put your name in an appointment slot to talk to an IUL specialist at no cost or obligation to see how these concepts may apply in your particular set of circumstances. But I want you to learn how to safely leverage with full liquidity and earn infinite rates of return like the banks do.